An OPEC cut, when they did that 2 million cut, it's actually technically not a production cut. It's a cut for the ceiling for how much they can produce. And what's interesting is they were already they were already missing and underperforming that ceiling. And if you go back to OPEC historically, it's actually been the problem of the other way around. Like they set a ceiling and then countries are kind of going over it, trying to, sell a little extra around the margins, kind of cheating a little bit. And so it's actually a matter of enforcing not going above it. Whereas in this environment, there's been the opposite where the majority of OPEC countries or a bunch of OPEC countries are failing to even meet their ceiling. And there's been good research by a number of firms when they've done like the detailed work on some of these countries. And they've argued that a lot of these are near capacity. With the current level of CapEx, in some cases, just the amount of reserves they have and just overall kind of maximum output they can do, that they're kind of tapped out. There's a little bit around the margins maybe, but they don't have this gigantic swing production that many people think they do, which is different than history. They might have to trim the production ceiling. You keep failing to meet your production targets. Eventually, countries realize you don't have what you say you have. And so this is, I think one way of managing the optics. There's also the question, because we're talking about OPEC Plus, which includes Russia, due to the war, the Western oil companies have had to pull out. They had capital and equipment and expertise that was part of Russia's production. And so the question is, we talked about oil declines, what happens in a year, 2 years, 3 years, if they can't recoup that level of investment to keep that production as high or higher than it is now? You could see a mild fall off in Russian production, for example. And so I think it's actually more a matter of OPEC not fully having the ability to keep amping it up. Then there's also a matter of geopolitical alliances, deteriorating conditions between U.S. and Saudi relations. And so essentially what that is saying, though, is that there is a floor there. They're willing to defend that floor, but also that they might not just have a lot of spare capacity. In the United States, you have pretty cheap natural gas. The question is, why can't we just send that all over to Europe? And of course, the problem is you need LNG infrastructure, which is expensive and time consuming to build. And then even if we get it there, then you need import LNG infrastructure, and then you need to have then the transportation to get that from the coast to the points where you need it. And so it's a matter of that type of infrastructure. It's a matter of refining. So you can have all the oil you want, but if you only have so much diesel production capacity, you can have a diesel shortage, even if oil's cheap, right? So there's multiple parts, there's multiple bottlenecks along the path to get right. So one thing that, North American or Europe, like Western countries can do, one is they could expand their exploration and production around the margins. They also can invest in more infrastructure, transportation, refining, things like that. In the United States, we've not added a new refinery in 50 years. We've expanded existing refineries. And that's because, they're not the most environmentally friendly sites. And there's always opposition, not in my backyard, no more refineries. And it's like, well, there is a trade-off for that. Either you have to import more of that product, or you're going to have shortages and high prices of that product if demand does not fall off with your capped or slow growing supply. In a prior era, if you saw oil, say, double, you'd be like, okay, drill, baby, drill. Let's get some more out of the ground. And now they're like, no, we don't know if it's going to stay here, and we don't know what the future clarity is. And so it's basically a different environment. It's a more bearish, cautious, defensive type of sentiment. And that's long-term good for price. And, that's part of why commodity cycles are so boom bust, is because of that delay between the price signal that tells you bring more oil online, and then, especially outside of shale, the number of years it takes you to actually bring that oil. And so usually those bear markets are characterized by oversupply that was financed during that prior boom. And then bull markets are characterized by the fact that, that spare capacity is eventually being worked out, either due to ongoing demand growth or just gradual decline rates and lack of sufficient new investment because of the bad pricing. And when that price starts to go up, if you don't respond to it right away, even if you do, it takes years for that new supply to come online. And in the meantime, just demand is really pressuring the existing supply. And that's kind of the story of commodities in general. And that's why they tend to have these roughly 15-year cycles. It varies a little bit, but in some ways it's like clockwork, because it's kind of just the overall investment cycle of what plays out. And then you can do an overlay of fiscal monetary stimulus that kind of serves as some of the transition points of, kind of economic acceleration or deceleration on top of that commodity overlay. And you get a pretty repeated cycle over the past century or so. If you compare oil to gold historically, it's not that expensive in the grand scheme of things. It's roughly around average. Basically, at that point, you're ignoring the fiat denominator that, everybody's seen those doom charts of the dollar losing 99% of its value over XYZ time period, things like that. So you ignore that, gradually debasing denominator, and you just compare to commodities. And so oil's roughly fairly priced in terms of gold. And even in terms of dollars, it spiked up to like 140 a decade and a half ago. And even from 2007 all the way to 2014, it was like an average price that was equal or higher than it is now. It had valleys during the global financial crisis. It had crazy peaks over 100. And, it eventually fell off a cliff after it got a supply glut from that shale we talked about. But really at the current time, it's not that expensive. European gas is, that's horrifyingly expensive. And so and coal had a huge, gigantic spike in price. So there are types of energy that are expensive. The oil market has not yet reached that point. I think it's, the years ahead, it's probably going higher. And, to your prior point, I think there's a lot of issues around managing to expectations rather than managing to outcomes, which is, trying to obfuscate, get anything dirty off the balance sheet rather than making it not exist. You just think you don't want it on our balance sheet because we have a bureaucratic quota to meet. In Europe, you guys have had like some facilities shutting down, fertilizer plants, aluminum plants and things like that because they're just no longer competitive at those electricity prices. And so that can help put a cap on electricity prices, but also puts a cap on economic growth and likely triggers recessionary conditions. And so an environment that can't get those cheap energy prices quickly becomes uncompetitive in the global market. And Europe has been a strong manufacturer. Any consumer, if they have to spend more money on their energy bill, especially they're spending more on energy and then that's revenue for another country because you're not producing it locally, that's less money you can spend on local goods and services. And so that's bad for the economy. And so that's the environment that many countries are in. So right now, the dollar is pretty strong relative to other currencies. So actual oil is pretty highly priced in euro terms, pound or yen, and a lot of frontier markets. Not necessarily some of the major emerging markets. They've actually held up better. But compared to a lot of currencies, oil is very highly priced. And it is putting a lot of pressure. And then it's, like I said, especially the natural gas, especially electricity prices, the coal. And so it's a matter of competitiveness and displacement of more discretionary purchases. Shale oil, the reason people went to it, in addition to just, new technology, new access, basically making life out of older wells, is that it's fast to market, right? So less upfront capital cost, but then you have quicker decline rates. And so it's, you're just getting out oil and gas quicker. Whereas if you do a gigantic offshore platform or, some of those gigantic like OPEC, wells, these are things that are very capital intensive up front, but then they have these long lifetimes. Kind of the same thing for like oil sands, right? So super capital intensive up front, but then once they're in place, they have very like low decline rates. And so during that environment, that kind of like easy money, new tech environment, it was all about that rapid oil to market. And the problem is that's like the Red Queen syndrome. So running in place and you have to run twice as fast just to stay where you're going. You have to run twice as fast again just to stay where you're going. And so that's the problem with shale. And that's why you can't just go from, say, 5 million barrels a day to 50 million barrels a day. And in this uncertain environment, there's not a lot of incentive to go for these longer duration projects because, they're being told by governments and investors, hey, we're going to phase you out, 5 years. And, I think a lot of those targets are unrealistic, but they're being told that. And they're also being told, we're not going to give you tons of like financing. In fact, we're going to give a premium to these like green bonds over here instead of yours to make their cost of capital lower. And also we might do windfall tax. And then so you have like the long-term spreadsheet of, okay, do I want to put a couple $2 billion into this like, 15-year payback period project? Probably not. And so right now we're kind of geared towards these quicker barrels of oil. But I think in order to solve some of these structural energy problems, we're going to need some of these longer term projects. And right now the incentive structure doesn't incentivize that until maybe prices get crazy or there's more kind of a future clarity around, maybe average pricing or that the fact that they know it'll be in demand, 10 years from now.